Hello, welcome back to Rational Investing. My name is Cameron Stewart, CFA. Thank you so much for tuning in again. We really appreciate the viewership. Make sure you hit that subscribe button and definitely comment down below. I love reading the comments and feedbacks, and it helps me choose what stock to do next. So it's very important you comment. Today, we're going to look at Visa. And we're going to do that as we do everything in this channel with the approach of value investing. How do we define the intrinsic value of a stock? That intrinsic value is based on free cash flow. And if we know what the intrinsic value of the business is, we can then look out into the market and see what the price is trading at and figure out if that's a good investment or not. It also helps us as the stock price moves up and down, which is random. If we know what the intrinsic value is and the price comes down, we have comfort in the fact that we bought something, we know what it's worth, and we can wait for it to come back. If you buy something based on stock movement alone, for example, if it crosses a 200-day moving average, and you say, oh, okay, it's now below this dotted line, therefore it's a buy, you buy it. If it doesn't go back up, what value, what underpinned the investment thesis to begin with? Nothing, just that it would revert to the mean it didn't. So this way, you're grounded in rational thinking, you're grounded in cash flow, and if the stock price declines, you feel a little bit better comfort than that knowing that you bought a company that's producing something you're going to get in the long term. All right. So every investment we look at for 5 different attributes. That would be top line revenue growth. That'd be strong EBITDA growth or earnings growth as we define earnings. Free cash flow, low debt, and a well-priced security. Those 5 attributes is how we classify investments, and we judge that to be a good investment or not based on those 5 criteria. So let's take a look at Visa. We're going to go through the cash flow, we're going to go through a market multiple approach, we're going to come up with what we believe the intrinsic value of the company is, we'll compare it to the market, and we'll come up with an IRR. Then what we will do is we'll look at a number of different price points. If over time price stock moves, we can figure out at what price is the best price for us to own this stock and when should we buy it. All right, let's take a look. Behind me is the most recent 10K. I've dug through it to pull out 10 years of financial information that I've presented here for you in a nice chart. What we're going to look at is where I first pick up revenue. And you're going to notice that revenue started at $9.2 billion in 2011 and has grown substantially. Nice growth, $22.9 billion. My hat goes off to the guys at Visa, guys and girls. Thank you very much. It's an excellent, excellent track record. The next thing we want to look at is EBITDA. We pick up an operating income, that's earnings before interest and tax. We add depreciation. We add any one-time adjustments to come up with an EBITDA. And that EBITDA is our proxy for free cash flow, and we can use it to create a market multiple approach when we're looking at intrinsic value. So here we go, EBITDA, 5.7 billion up to 15.6 billion. Fantastic. Triple your cash flow return or appreciation, and that margin growth is faster. That growth here is faster than this. That means their margins are growing. That's excellent news. So we got top line revenue growth. We've got strong EBITDA growth. Let's look at enterprise value. We're going to pick up the debt. Debt started at 0, went to 18.7 billion. So definitely having added debt. But the market cap has grown based on this EBITDA growth from $52 billion to $354 billion. Add these together, you get enterprise value. Now, enterprise value is what we look at when we try to establish intrinsic value of the business. It's the business as a whole. It's everything, including debt. If you wanted to buy the entire business, that's what you want to look at. That's the most important factor. Enterprise value. I divide enterprise value by EBITDA. I get a market multiple. You can see it trades at a healthy premium. At least in the last decade, it certainly has. High teens, even most recently up to a 30, which is shockingly high. But that's the range. It's currently averaged at 18.3, and the debt to EBITDA has been low, very low, barely above 1.5. And that's another hallmark that we like to see of an investment, is something with low debt. Because if the economy turns, you want to have a company that's going to last. If you're putting your money in this and you want to hold it for 5 to 10 years, you want it to make money for you regularly, and you don't want to lose sleep over it at night. So now we've looked at 3 factors. Top line revenue growth, check. EBITDA growth, check. balance sheet, solid balance sheet as defined by debt to EBITDA. Excellent. Let's go look at free cash flow. Where the rubber meets the road and how you really value a business is we pick up from operating cash flow, CFO. All right, cash flow from operations 3.8 or 3.9 billion up to 12.7 billion. Fantastic. That growth is in line with EBITDA growth and revenue growth. It's excellent to see. CapEx. What do they have to reinvest in the business to keep that cash flow going? And what I'm happy to see is this margin, this ratio here of the netting these two, the 3.8 billion minus the 350 million. This is so much smaller than this. They have such free cash flow. It's incredible. And I think that's why you see them trade at a higher multiple than typically other stocks with that EBITDA multiple, right, being almost at 30 times or at least 18 averaging. Why is it trading higher? Because the cash flow is so much higher, right? They don't have to put a whole lot of money into the business. Why is this important? If the economy downturns, say you've got a big chunk of your wealth in this company, stock price moving all over, economy goes into recession, consumer credit falls, they stop using the credit card, it retracts a little bit, okay? If they have a lot of debt, if they take a lot of capex to fill like a Carnival Cruise, those cruise line ships that take a lot of money in here, that means that they have very little cash flow at the end of the day to pay debt service, which is key to staying in business. Here, that's not the case. Debt is already low, and the cash that they have to reinvest in the business is low. So every dollar that they keep in earnings turns into free cash, a lot of it. Not every dollar, obviously, but a lot of it. And because of that, they get a higher multiple in the market. The stock investors are rewarding this business for having such tremendous margins. So here we go. Free cash flow to operations, less capex, plus or minus the net debt. In this case, they borrowed some here, and then really haven't done a whole lot of borrowing past that. They use a lot of preferred stock for their for the capex, for the capital expenditures we'll get into. So there's not a whole lot of debt on the business. Free cash flow to equity is strong. Shares outstanding, free cash flow per share. Stock price averaging in the September month for a yield. 5.1, it's a strong yield. We've seen a number of companies on this channel that yield at the 5 range. There's a very strong free cash flow. And again, intrinsic value of a business is what it pays you. Forget the stock price for a minute, whether you think it's going to go up or down the next day. That's a coin flip. And anyone tells you whether they think the stock price is going to go tomorrow or next month is guessing. And if you believe in them, you're gambling too. This is rational investing. Rational investing is pinned in a value-based intrinsic value approach. That intrinsic value is based on free cash flow. This yield is a strong free cash flow that we can use to value the business. And the growth rate. Look at the growth rate plus that, plus the free cash flow yield. That way you can use to grow the business. Okay, so we've got strong free cash flow. Let's take free cash flow forward in time and forecast a future value of the business based on free cash flow. We'll also do that for EBITDA. We'll take 2 estimates of future value. We'll average those to come up with what we believe the intrinsic value of the business is in the future. And we'll compare that to the current price and come up with an estimated return. So let's walk forward in time. Here's our forecast. We picked up the free cash flow per share and we're growing that. I'm pegging 15%. That's less than the growth rate they have in the past of 45%. Very, very strong. And we're going to grow that. I'm decelerating it as they get bigger. $16 in a decade from now. I use a 5% yield and I get $329 per share. If we look at the EBITDA, roughly the same approach. I'm taking the EBITDA we saw before, roughly 16 billion, growing it here at 13.5 because the growth rate is a little less, 13.5. And I'm decelerating that growth rate as they get bigger. It gets tougher to grow. I get a 10-year forecast EBITDA of $45 billion. I'm applying the average market multiple of 18 times on that business, less the debt, which is relatively low considering what they have. I give me a market cap of $788 billion. Shares outstanding. These shares, that's a lot. 2.5 billion shares is a lot. And what I've done is they have some preferred stock on their books They also have a couple different layers of common stock. That's how they fund the cash required to lend out and get the working capital. Some of that's convertible into common stock. So I've assumed all of that gets converted, and therefore the fully diluted shares outstanding divided by the market cap gives us $311 as a future stock price. So now we have two estimates of what we think intrinsic value of the business is in 10 years. We're going to average the two. I don't know which one to buy in more or less, but they're both close. So we're going to split the difference and call future value $320. Most recent stock price $69, excuse me. Here's our IRR calculation. So again, we've got the future cash flows that we expect to receive either through share buybacks or through dividends. We're going to get in at $169. We're going to receive those distributions for a decade, and in a decade we'll sell the stock for $320, and that is going to net us an annualized rate of return of 13%. It's a pretty solid return. A little less than market. We like to see 15% or higher, but it's still a strong return. There's strong cash flow. There's low debt. I think here the upside here for Visa as they continue to grind higher is better than the downside, and I certainly think the 13% IRR is very respectable. You'll get 2.5 times your money over the decade with continued cash flow every month, or excuse me, every year, which is really nice. So I think this is a very good, very attractive investment. What we're going to do is we're going to then look and see how can we enhance that return. Me personally, I think the 13% is a little low. I'd like to see something north of 15. I'd like to see if I can find in the 20% range. It's tough. But if you can find something north of 15, that's outstanding. I think this is solid at 13. But if we think that the intrinsic value is $320 in 10 years, that's what it is. All right. The value is not going to change. What changes is the price that you can buy it at every single day. Remember, price is what you pay, value is what you get. So the value you're getting is $320. This price moves around all the time, up, down, whatever. So if we sit back and we say, I want a higher return than 13%, how do we do that? All right, we don't have to make more aggressive assumptions around what we think this number is going to do. No. Sit back and wait for the price to come to us. Let's look at the return distribution that we can achieve. What we've done in the past, and what I said I'll continue to do, is give you a range of stock prices and what that stock price does to the economic return. Now remember, the intrinsic value of the stock hasn't changed. We're still saying it's $320. But as you know, the stock price itself moves every day up and down. And depending upon what happens in the economy, people could wholesale sell the stock regardless of value. And that allows us, who know the intrinsic value of the company, to step in at a reasonable price and get an outstanding return. So here is the stock price, $140 through $200, and the IRR over the 10 years, assuming that $320 intrinsic value price. And as you can see, if the price comes down, your economics go up nicely over the decade. If you can find the stock at some point in the future in that 140 to 150 range, which would be tough, believe me, I've continued to watch it, but your return is outstanding for another decade. Every single year to make 16% is a really attractive investment. So what you can do is if you find a stock you like the revenue growth, the EBITDA growth, free cash flow strong, solid balance sheet, but it's not quite priced, what you do is you put that in your watch list. You come up with a target price that you would buy it at, say in this less than sub 160 range, and then you sit back and wait. And that way when the market completely melts down, you already know what the intrinsic value is, and you feel comfortable putting money to work in dangerous times. That's how people like Warren Buffett, Bill Miller, William Sharpe, some of these legendary investors, how they look at a risk-return ratio, and they wait for that margin of safety to happen so that they can get into a solid stock and know that there's a little bit more protection, that the market's given up some of the upside and they can step in and get a nice return for a long time. And if you're able to buy that, holding that for a decade will do you quite nicely. Okay, So this is Visa, a quick review of the intrinsic value and a quick review of where we think the stock price could be. Thank you very much for watching Rational Investing. My name is Cameron Stewart, CFA. Please subscribe and comment. Love the feedback and let me know what you want to see next. Thank you very much. Bye-bye.